Good morning. Today we're diving into a story that affects every Indian, whether you're planning a vacation, running a business, or just buying groceries. On August 20th, 2025, the Indian rupee slipped to 87.16 against the US dollar. While this might seem like a minor drop, it's actually part of a much larger and ongoing trend that's been building over the past several months. In practical terms, this means you now need 87 rupees and 16 paise to buy a single US dollar, compared to 87.13 just yesterday. That's a difference of only a few paise, but these small changes add up over time and can have a big impact on the economy. Even a tiny shift like this signals deeper pressures on our currency, shaped by a complex mix of local and global forces. It's not just about numbers on a screen. It's about confidence, trade, and the movement of money across borders. For everyday Indians, a weaker rupee means foreign travel, imported electronics, and overseas education all become more expensive. Families sending money abroad or students paying tuition fees will feel the pinch. On the flip side, Indian exporters might benefit as their goods become more affordable for buyers in other countries, potentially boosting sales. The rupee's decline isn't just a random event. It's a reflection of cautious investors, shaky stock markets, and a world filled with economic uncertainty. When global investors get nervous, they often pull money out of emerging markets like India, putting extra pressure on the rupee. Right now, the forces weighing down the rupee, like global inflation, rising oil prices, and shifting investor sentiment, are stronger than those supporting it. This imbalance is what's driving the currency lower. In the next sections, we'll break down what's driving this pressure in detail, from global events and international markets to India's own stock exchanges and trade relationships. We'll also explore how international headlines, such as geopolitical tensions, changes in U.S. economic policy, and even decisions made by central banks, can ripple through to your wallet and daily life. So let's demystify why the rupee is moving the way it is today, and what it could mean for you in the days ahead. Let's zoom in on this morning's market action and break down what's really happening behind the numbers. The opening bell set the tone for a day filled with uncertainty and cautious sentiment, as traders and investors braced for fresh data and global cues. The rupee opened at 87.16 per US dollar, already weaker than yesterday's close of 87.13. This early dip signaled that the currency was under pressure right from the start, reflecting both local and international headwinds. It briefly strengthened to 87.10, but quickly lost ground, reflecting persistent selling pressure. The volatility in the first hour was a clear sign that traders were nervous, reacting to every new headline and data point. Domestic stock markets echoed this mood. Sensex dropped 146 points, and the Nifty fell by 47 points at the open. These declines weren't just numbers. They reflected a broader sense of unease about the economic outlook. When stocks fall, foreign investors often pull out, selling rupees to buy dollars, pushing the rupee down further. This cycle can quickly intensify, especially when global risk appetite is low. The US dollar index, which tracks the dollar against major currencies, rose to 98.36, showing the dollar's global strength. A stronger dollar makes it even tougher for emerging market currencies like the rupee to stay afloat. This makes it even harder for the rupee to hold its value. Every uptick in the dollar index adds more pressure, making recovery a challenge. Yesterday, foreign institutional investors were net sellers, pulling out over 634 crore rupees from Indian equities. Such large-scale selling is a clear signal that global investors are wary of current market conditions. Such outflows directly weaken the rupee, as investors convert rupees to dollars. This not only impacts the currency, but also puts additional strain on the broader financial system. These numbers confirm a cautious, risk-averse mood among global investors. With so much uncertainty, many prefer to stay on the sidelines or move their money to safer assets. The rupee's weak start today is a direct result of these combined pressures, both from within the country and from global markets. It's a clear sign that both global and domestic factors are working against the currency, and unless there's a shift in sentiment or policy, the rupee may continue to face an uphill battle in the days ahead. The rupee's fate is closely tied to its Asian neighbors. Today, many Asian currencies are also down against the dollar, creating a regional wave of weakness. Investors often treat Asia as a single block. If they're nervous about one country, they pull back from the whole region. When currencies like the Chinese yuan or South Korean won fall, it drags the rupee down too. Most Asian economies are export-driven and sensitive to global shocks, so bad news anywhere in the region can trigger a sell-off everywhere. This morning's weakness among Asian peers made it even harder for the rupee to resist the dollar's strength. The rupee isn't just reacting to India's issues, it's caught in a broader regional downturn. To understand the rupee's moves, we have to look beyond our borders. Asia's collective sentiment is a powerful force in the currency market. The rupee and India's stock markets move in tandem, each influencing the other in a delicate balance. When the markets catch a cold, the currency often sneezes too. Today's sharp drop in the Sensex and Nifty signaled a wave of investor anxiety, prompting many foreign investors to quickly offload their Indian shares and seek safer havens. When these investors exit, they sell their rupees to buy dollars, increasing the supply of rupees in the market and putting downward pressure on its value. This sets off a feedback loop. Falling stocks weaken the rupee, and a weaker rupee, in turn, scares off even more investors who fear further losses. For example, if the rupee drops from 87 to 88 per dollar, foreign investors lose money when converting their Indian assets back to dollars, making Indian investments less attractive. To avoid further losses, they may rush to sell even more, deepening the decline in both the stock market and the rupee's value. Today's negative market opening was a clear domestic trigger for the rupee's weakness, setting off a chain reaction that rippled through financial markets. It shows how quickly local sentiment and panic can translate into real currency pressure, sometimes within hours. While global factors like US interest rates or oil prices set the broader stage, India's own markets act as a direct and immediate channel for rupee volatility. The world watches these signals closely, as India's market moves can send ripples across other emerging economies. Domestic market jitters are a key reason for today's rupee slide, reminding us how interconnected our financial systems truly are. Global politics, especially the Russia-Ukraine conflict, loom large over currency markets. Any hint of peace talks calms investors, but fresh tensions send them rushing to the safety of the US dollar. This flight to safety strengthens the dollar and weakens currencies like the rupee. The conflict also affects oil prices. If Russian supplies are threatened, oil gets pricier. India, a major oil importer, then needs more dollars to pay for energy, putting extra pressure on the rupee. Even a small uptick in oil prices keeps markets on edge. Today's cautious mood is partly due to the lack of progress in Eastern Europe. Until there's a resolution, the rupee will remain vulnerable to global shocks. All eyes are on the Jackson Hole Symposium, where U.S. Fed Chair Jerome Powell will speak. His words on U.S. interest rates can move markets worldwide, including India's. If Powell hints at higher rates, investors may pull money from emerging markets like India to chase better returns in the U.S. This triggers capital outflows, weakening the rupee as investors sell rupees for dollars. Even the expectation of a hawkish speech can spook markets. Until Powell speaks, traders are cautious, keeping the rupee under pressure. The interconnectedness of global finance means a speech in Wyoming can shake Mumbai's markets. The rupee's fate is tied to decisions made far beyond India's borders. India's direct relationship with the U.S. is another key factor for the rupee. Recently, the U.S. warned India about its trade ties with Russia and China, threatening new tariffs on Indian goods. Tariffs would make Indian exports pricier in the U.S., hurting demand and reducing dollar inflows to India. Even the threat of a trade dispute makes investors nervous, adding to rupee pressure. The U.S. dollar also strengthens when America takes a tough stance on trade, as seen in today's rising dollar index. These tensions add a specific risk for the rupee, on top of global uncertainties. Strong trade ties support the rupee, but disputes do the opposite. Investors are watching U.S.-India relations closely for any signs of escalation or resolution. More friction could mean more weakness for the rupee. Diplomatic progress, on the other hand, could offer relief. Why does the rupee's value change every day? It's all about supply and demand. Think of the currency market as a giant bazaar. If more people want rupees, its value rises. If more people sell rupees, it falls. Foreign investment, exports, and remittances boost demand for rupees, strengthening it. Imports, overseas education, and foreign investors pulling out increase rupee supply, weakening it. Every transaction, buying oil, sending a student abroad, or selling stocks, shifts the balance. The exchange rate you see is where supply meets demand at that moment. News about interest rates, politics, and trade policies constantly change these flows. That's why the rupee's value is always in motion. Understanding these basics helps make sense of the daily headlines. The rupee's journey is shaped by millions of decisions, big and small. So, what's next for the rupee? Experts say the outlook remains cautious. Until there's clarity from Jerome Powell's speech and the Russia-Ukraine situation, the rupee is likely to stay under pressure. Watch for key events. The Jackson Hole Symposium, updates from Eastern Europe, and foreign investment flows into India. If foreign investors return to Indian stocks, the rupee could stabilize. Falling global oil prices would also help by reducing India's dollar demand. For now, the rupee is caught in a storm of global and domestic uncertainty. But currency markets are dynamic. Today's pressures could ease tomorrow. Staying informed is the best way to navigate these changes. By understanding the drivers, we can better anticipate what's ahead for the rupee. The story of the rupee is a window into the world's economic pulse.